to get started in a couple minutes here. Our keynote speaker has arrived, so we'll be waiting for him to, everybody should get seated. I'm Jack Markowski. I'm from Community Investment Corporation in Chicago, and I'm chairman of the NAAHL Board of Directors. And on behalf of the Board of Directors, I'd like to welcome you all to our annual conference on our Policy and Practice Conference. And the theme of today's conference is What's Next for Neighborhood Finance. I'm very glad that all of you can join us. We think we have a very informative and packed agenda, and we'll have a lot of good discussions and information exchange throughout the day. I'd like to thank our sponsors. They're listed outside, all the sponsors who have made this conference possible. Well, this is Congressman Gregory Meeks is our keynoter. So I'd like to introduce Congressman Meeks. Congressman Gregory Meeks is in his 11th term representing the 5th Congressional District of the state of New York. His efforts in Congress have earned him widespread respect throughout the country. He's known for his effective, principled, and common sense leadership. Congressman Meeks grew up in public housing in New York, and from his parents, he inherited a profound sense of social justice and a commitment to community. After graduating from Howard University Law School, he served as a Queens County District Attorney, an anti-narcotics prosecutor, a chief administrative law judge in New York State for the workers' compensation system, and finally was elected to the New York State Assembly in 1992. He was first elected to Congress in a special election in 1998. In the U.S. House of Representatives, Congressman Meeks is a senior member of the House Foreign Affairs Committee, and most appropriate to us today, he's a senior member of the House Financial Services Committee. On that committee, he serves as chairman of the Subcommittee on Consumer Protection and Financial Institutions. This is a subcommittee that oversees all financial regulators, the FDIC, the Federal Reserve, and it also oversees all matters pertaining to consumer credit and the stability of the banking system, all exactly what we're talking about today. So as we pursue our conversation on neighborhood finance, equitable development, and CRA modernization, he's an ideal person to kick off our conference today. So I introduce to you Congressman Gregory Meeks.
Thank you, Jack, and good morning, everyone.
Good morning.
Delighted to have you in Washington, D.C. on this 75th anniversary of D-Day, which is most important to everyone in this room as we commemorate and congratulate and remember those who put their lives on the line so that we can live in the manner that we're living today. So I am delighted to be with you. Let me just, first also thank Buzz Roberts for being who he is on the Hill, making sure that he's focused on the committee and what we're doing. Buzz is one that communicates with us on a regular basis, and so Buzz, we thank you for your friendship and your continuing to work with us on the Financial Services Committee. As Jack indicated, I'm the chairman of the Consumer Protection and Financial Institutions Subcommittee, and it's critical because we consider the complexities of an evolving banking sector, enabled by rapid developments in technology and critical important issues of consumer protection. Affordable housing is a case example of these opportunities, as well as the challenges and the importance of not losing sight of our obligation to American families while finding a balance and ensuring dynamic, inclusive capital markets. The scope of issues before the subcommittee is broad, as evidenced by the 4 hearings I have already chaired in the past 4 months. In other words, we've been very busy. These include a cannabis banking hearing. We've had a very unusual situation where citizen initiatives are leading to states legalizing research, medicinal or recreational cannabis. But cannabis is still considered an illegal drug at the federal level. This has created an incoherent system where activity that is legal at the local level is illegal at the federal level. And as a result, banks and insurance companies, credit card companies, and other financial services cannot enter the space. This creates a security risk for the industry and the general public, and uncertainty and regulatory risk for financial services companies. We passed the bill out of committee with bipartisan support. Yes, we still do some things sometimes bipartisan, giving banks and insurance companies safe harbor for FinCEN and thereby rectifying this situation. The bill should be voted out of the House in July, and we hope to get sufficient support, again in a bipartisan manner, from Republicans to put pressure on the Senate to move this legislation so that it is not one of the many bills that die in the graveyard known as the Senate. The other hearing we conducted was payday and small dollar loans. It is commonly referenced data point that over 40% of American households, cannot afford a $400 emergency without borrowing money or selling something they own. In the strongest economy in 50 years, that is damning. The reality about the structure and fragility of our economy and the lack of resilience of our American households, we should be concerned about that. And I believe that we have an obligation to take action to find a right balance between access to credit for the unbanked and underbanked and consumer protection from predatory practices. In particular, loan products that are designed for borrowers to fall into debt traps are not in the interest of borrowers. This is an issue we must contend with, given expanding banking deserts, growing numbers of unbanked and underbanked communities and segments of the population that are in both rural and urban areas, and online lending and fintech solutions. And again, this is something we're looking at in a bipartisan way because it affects us. Whether you're in the north or the south or the east or the west or the Midwest, middle of the country, Democrat or Republican, it's affecting all of us. And so something that we should be doing in a bipartisan way, and I hope hopefully we'll get more folks, more of the larger financial institutions back into the small dollar loan business and figure out how we can do that. Third, in fact, yesterday, I chaired a hearing on leveraged lending. In considering the systemic risk that leveraged loans present or may present, I was in Congress during the 2008 financial crisis. One of the worst times. I've been in here, Jack said, since 1998. I would say two of the most horrific times for me was, of course, 9/11, 2001, but also when in 2008, Secretary Paulson came to the floor of the House of Representatives and said that we needed to do something immediately or our financial systems, as we know it, would be in ruin. I don't ever want to go back to that time. I don't want to see that situation again. So as a result of that, we did many things in the Dodd-Frank Wall Street Reform Act, which I believe have proven to be a great success in updating our regulatory framework and addressing future potential systemic risk. Of note, FSOC created a statutory framework for regulators to work in concert to monitor systemic risks and designate systemically risky institutions, and outside of the banking system for heightened prudential oversight. Also, key was the creation of the Office of Financial Research, which was tasked with identifying, quantifying, and mapping existing and emerging systemic risk. The current administration has been diluting the authority of FSOC and gutting the OFR, which is not wise given that they were established to serve as an early warning systems for systemic risk and ultimately to protect U.S. taxpayers and Main Street from any future systemic failures in capital markets. And in our hearing yesterday, we were talking about it, we wanted to be clear. We're not saying that leveraged lending is a systemic risk. We're saying that the regulators that we put in place should be able to examine it so that when we ask them whether or not there is a systemic risk, they can say affirmatively, no, it is not, because we have all of the tools, we've looked at it, and if it is, we are prepared to prevent a systemic risk or prevent it from being the catastrophe that took place in 2008 where the system was almost broke down. And fourth, and I think very important, and as to you too, I've been very vocal on the importance of CRA modernization. I know that NAAHL has also, and the Community Reinvestment Act was, as you know, enacted in 1977, as a direct response to the long, painful legacy of structural discrimination, financial exclusion, and economic suppression of racial minorities in America. Banking, finance, housing, and access to capital more broadly are the key pillars to opportunity in breaking cycles of poverty and exclusion. How do I know? I come from a family of very humble means. I grew up in public housing. My parents migrated from the South. The one desire that they had was to save enough money so that one day that they could own a home and live with a backyard and enjoy part of what we call and what we all know as the American dream. My parents' access to financing to purchase a home, therefore, was one of the most important circumstances that laid a path for me to go to college, to become a lawyer, and ultimately to serve as a member of Congress. But for that, I would not be standing here today. My siblings' lives were equally impacted by my parents' ability to build equity and allow us to grow up in a dignified home. In fact, often we talk about what, and I tell folks when I was running for Congress, and often and still now after the crises, that what we should be doing is buying the home and renting the car, as opposed to buying the car and renting your home. Because one, and still is proven today, a home is an appreciating asset, and a car is a depreciating asset. Very basic information, and we need to still, as Americans, to understand that, because if it wasn't for that appreciating asset in my parents' home that helped pay for my education, I would not be here today. And if I was, I would be, because one of the biggest crises in America today is the cost of education, and too many of our young people are spiraled in debt as a result of education and that they can't get out of. Because even with my parents putting some money toward my education, they couldn't afford to put all of it, so I still had to take out student loans. And I know how it took me 15 years to pay off my student loans, and so therefore there was no balance with some of my other friends and colleagues who did not have a student loan. So what I had to pay in student loan was a rent or mortgage check or an investment, something for them, so I was behind the 8 ball for over 15 years and had to pay. And so you can imagine the cost that our young people, the debt that our young people have today, how it is affecting them. Yet still I can give examples of individuals, of friends of mine, whose parents did not move out of the old neighborhood, did not buy a home, did not get equity. And as a result, many of them could not finish their education, and thereby, I truly believe, never met their full potential. and their full contributions that they could have made to the American society. So that is, when I look at and think about what we need to do and the importance and significance of what you do, we can't shortchange it because we don't know the future of someone's life that will be affected by it. Owning a home is still an important place and thing to do. And we cannot downplay the legacy of redlining, structural discrimination in the financial sector, and how its impact echoes through time to this very day. It still exists. That's why we've got to stop it. So ultimately, I believe that we are all interested in ensuring that banks and lenders continue to meet their obligations to the unbanked and underbanked, and that evolving business models and emerging technologies do not lead to increased exclusion or new patterns of discrimination. The CRA undoubtedly needs to be modernized. And I'm glad to see that the OCC, the Fed, and the FDIC work closely together to harmonize their approaches to CRA modernization. I recently had a conversation with the chair of the Fed, and he assured me that they were working to get something done in that regards, and I think that it's important, and we need to make sure that, in today's world, where we talked about banking deserts, that we understand that sometimes you don't physically have to have a structure in an area. If you're doing business there, we should figure out how CRA is applied so that everybody, who's doing work or who's investing in an area, the community also benefits and the people there. And finally, I'd like to touch on two issues that I'm certain are of particular interest to you. The first, of course, is GSE reform. So the question, and I know I'm going to ask you, let me answer your question, one of your questions first right now. Question most folks ask me, is GS reform going to happen in this Congress? My honest answer is it's extremely unlikely. And here's where, given divided government and the administration, we just, on serious issues like this, have proven to be unreliable negotiating partner, especially the administration. However, it's forced to perceive that nothing has happened to GSEs in the past decade, as many positive changes were implemented during the last administration in particular. I would argue that the main objectives of the administration or of Congress in tracking GSE reforms should be to do no harm and to build on a positive legacy of facilitation of home ownership. That still should be the bring. Are we focused on trying to make sure we're helping individuals own a home? And I think that we see that that's starting to come back. I know in the district that I represent, which is primarily a home ownership community, for a long time after 2008, we saw homes that were laying vacant because people who were put out of their homes. And now it's been, trying to figure out how do we get folks back in their homes? How do we get first-time home buyers to buy in their homes and make it affordable for them? And I think that we are finding some ways, and we need to continue to look at that and focus on that as we're moving, because I'm a strong believer in home ownership. Let me close with CECL. And my hope is that all of you here today have heard about CECL and the implementation challenges. I am very concerned that the underbanked and communities of color are most at risk from negative implications of CECL. Indeed, I believe that CECL may pose one of the greatest risks to minority home ownership, given the capital that will need to be held against all of us in Congress. This is particularly concerning, given that following the recent financial crises, African-American home ownership is down to pre-civil rights numbers. pre-civil rights numbers. I've raised these concerns with all of the prudential regulators and with FASB, and I'm planning additional bipartisan members and staff briefings. I want this to be completely bipartisan. And will continue engaging with Chairwoman Waters to agree on an actionable path forward, given that FASB appears dug in on the issue. This issue has drawn strong bipartisan and bicameral interest, and I believe that a path forward should be achievable. It's important. Me and the ranking member on my subcommittee, Mr. Lukemeyer, we've been talking on this increasingly, and we're trying to find the pathway. Some on my side of the aisle, well, on both sides of the aisle, on my side of the building, on the House side, are looking at whether or not we should follow what has recently taken place in the Senate. The Senate first sent out a letter, and now they're looking at legislation. We're trying to debate on our side whether it should be legislation, as FASB does not stop, look, study on its own what the ramifications may or may not be by changing these accounting standards. And we're talking, and Chairwoman Waters is listening, and everybody's approaching from both sides. So we will see what happens, but I don't think that such a drastic change should occur without making sure all of the appropriate studies have done, because it could be very detrimental to home ownership, particularly for people of color and those who do not have a lot of money. So let me conclude by just saying I want to thank all of you for being here, for what you do on a regular basis, for your team at NAAHL, for your hospitality, and I look forward now to just opening it up to some questions that you may have.
Thank you, Congressman Meeks. We have time for a few questions. I wanted to tell everybody now and during the day there will be mics in the roving mics in the audience. Do we have our roving mics? There's one over there, I see, and one over there. Good. So if you have a question, raise your hand about anything Congressman Meeks has said, or about, how about, Congressman, the issue you brought up, number 3 or 4, was about CRA modernization. And that's a lot of what we deal with here. We have a panel on that later today. We're all looking forward to the proposed rulemaking that we understand will be coming out in the coming months. What are some of the key things you mentioned about? One of the things we talked about yesterday with Chairman McWilliams was branch banking and internet banking, and do we need branches in particular communities that seem to be important, but is that the way banking is going? And how are people going to have access to the financial system?
Yeah, that's why I think that we've got to make sure that it's not so structured that you can't make sure that CRA applies in a more broad and creative way. Look, fintechs and doing, is clearly a move to the future, and they won't have physical branch in various districts. I'm not one to think that, because of technology, we're not going to slow it down, nor should we. We're not going to stop it, nor should we. It's going to increase. I know that, I see in my community, for example, in my district, if you are, almost 35 or under, look at my kids, they're not going to a branch.
Right.
They just take out their little iPhone or whatever phone they have, or their iPad, and they get online and they borrow money if that's what they're going to do. Or they look and search. When they bought their house, they searched for their mortgage online. They didn't go to a bank as I did. Seniors and a number of other folks old like me, sometimes I still want to go to a branch. I just I haven't gotten that comfortable yet. But seeing in the future, you're not going to have as many branches. Yeah. And so CRA has to be able to look and take a perspective of, okay, you don't physically have a branch in a particular area, but you're doing a lot of business in that area. And so therefore, you can get CRA credit, and we figure out what would that encompass. And so we mentioned this to the three, to the FDIC and the Fed and the OCC, and they should be taking some of that in consideration. When the OCC did some initial, their initial findings, and look, when it was just the OCC, we went back at them as a result of that, because that was a concern that we had at that time.
What about another thing that's come up in CRA is controller auditing and various versions of the single ratio. Let's make everything simple and clear, and we'll establish how much you have to, some way of valuing this, but some numerator and some denominator of this is how much you got to do to satisfy CRA, whether it's services, investment, lending, anything. And so I know there's concern about that. Is that really going to capture the scope of financial services? But I don't know where that stands.
Yeah, I think that that's limited. I don't think that's creativity. I think we have to start thinking out of the box when we start talking about CRA going forward. And that's why I think that once they come out with, with their initial findings, there's got to be a large public response to it and get some out of the box thinking. The Fed, by the way, said that they had a very important role that they were playing, and they agreed, at least initially, that I would be more pleased when I see their part of it as opposed to just the OCC, because they were doing just that kind of out of the box thinking, which I think is extremely important.
Great. Any other questions? Concerns? Messages you'd like the Congressman to bring back to Congress?
I like this. Y'all are an easy audience. That's
Yes.
You mentioned CECL and assumed that it was on everyone's mind, but it became on everyone's mind because we were wondering, what's CECL? So for those of us who aren't living deeply in the credit world of the bank and aren't hearing that, can you elaborate on that for us?
Yeah, CECL changes the accounting standards that banks, especially CDFIs and others, of how much money that they have to put in reserve. So it changes so that you have to put money as if that when you take in the loan, that the loan is going to fail. So you got to hold that money up front. You're almost making the presumption that the loan is going to fail. Someone is not going to pay it back. So therefore, the amount of money that you hold in reserve is a greater number. And so we believe that if you utilize that standard, then the money that you got to hold will limit the loans that you can put in, as well as you're not going to even, some folks, I think that, especially with smaller banks and credit unions, et cetera, they look at the person better. My parents, when I talk about this house, I can recall when they bought their house. I was in college, and I remember going with them to the bank when they were negotiating that mortgage. Now, they had to struggle to qualify because they didn't make a whole lot of money. So the bank, worked with them to look at it, to see, and then they became aware. They took a chance, I would admit, but they felt confident that if there was only one thing that my parents was going to pay, was that mortgage. So under these new standards, that would almost be eliminated. And you wouldn't be able to look at the whole person or the whole family or who was taking out that loan. And I think that as a result of that, you could have the unintended consequences of limiting the loans that goes out to individuals who can and would qualify and pay for their mortgages.
All right, join me in thanking Congressman Meeks. Thank you very much. Good luck with everything. Thank you, Congressman, and best wishes to you, and we'll help you in any way that we can to make sure that we all have credit access going forward.